Welcome to Global News Headlines Today.
Global Edition, Daily World News Bulletin, Thursday, April 30th, 2026. All updates verified by Grok with real-time X.com references. Silver paper price versus silver physical. Price huge profit earnings update. Paper silver just dipped again into the $72 to $74 zone. But while the screen price looks calm, real physical silver is getting harder and harder to buy. Premiums are climbing, dealer inventories are shrinking, and the COMEX is flashing warning signs. This is the paper versus physical split in silver, and it is bigger today than it was in 2021. If you just watched our last deep dive on the silver shortage and the coming May earnings explosion, this video is the perfect next chapter. Today, we break down exactly how the paper market is hiding the real supply crisis and what that means for your stack and your wallet in 2026. Let us start with the basics so you fully understand the game. Paper silver is the price you see on your phone or trading screen. It comes from futures contracts traded on the COMEX in New York. Most of these contracts are settled in cash, not actual metal. Big banks and hedge funds use them to bet on the price without ever taking delivery. This creates a massive paper market that is many times larger than the real metal supply. Physical silver is the real bars, coins, and industrial ingots that get delivered and used. These are the ounces sitting in your safe, in dealer vaults, or heading to solar factories and data centers. When demand for real metal rises, physical silver tightens up fast, even if the paper price gets pushed down. Right now, in late April 2026, we are seeing a classic extreme split. On the paper side, the spot price trades around $72 to $74. Futures traders have been selling contracts and pushing the price lower in the short term. On the physical side, premiums are rising. Many popular 1-ounce coins and 10-ounce bars now carry 5 to 15% or higher premiums over spot. Some popular products already have wait times of weeks. Large industrial buyers report tighter supplies and higher negotiated prices. This is the disconnect in action. Let us look at the hard numbers that prove the split. COMEX registered inventory, the metal actually available for delivery, sits around 75 to 77 million ounces. That sounds like a lot until you compare it to open interest. The coverage ratio is down in the low teens %. In plain English, there are far more paper claims on silver than actual metal ready to ship. The Silver Institute reports the sixth straight annual market deficit in 2026, projected at 46.3 million ounces. Since 2021, we have already drained over 762 million ounces from above-ground stocks. That buffer is basically gone. Meanwhile, demand keeps roaring. AI data centers need up to 3 times more silver per server rack. Solar farms still consume 150 to 200 million ounces every year. Electric vehicles and charging stations add another big chunk. All of this real metal demand cannot be satisfied with paper contracts. This split has happened before, but the current one feels more dangerous because the above-ground inventories are lower and industrial demand is structurally higher than in past cycles. What does this mean for you as a stacker or investor? First, the paper price no longer tells the full story. When the split gets this wide, history shows physical buyers eventually force the paper market to catch up, often with a violent move higher. Second, if you are waiting for a big dip to buy more physical silver, you may be waiting a long time. Premiums can stay elevated or even rise while the spot price wobbles. Third, the coming May earnings from Pan American Silver, Hecla, First Majestic, and others will show how profitable miners become when they sell real metal at $75+ while their costs stay low. Those profits will highlight how disconnected the paper price has become from reality. So what should you do right now? Focus on stacking real physical silver while you can still get it at reasonable premiums. Prioritize what you can actually take delivery of: coins, bars, or even allocated storage with proven vaults. Consider dollar cost averaging instead of waiting for the perfect dip. If you want exposure to the mining upside, look at the low-cost producers we covered in the last video because their earnings will prove the real economics of silver. This paper versus physical split is not some conspiracy theory. It is basic supply and demand mechanics playing out in a market where one side is mostly paper bets and the other side is real metal needed for the future. Silver is not just an investment. It is the critical metal powering AI, solar EVs, and defense. And right now, the paper market is trying to ignore that reality. Drop your questions in the comments. Are you seeing higher premiums at your local dealer? Which form of physical silver are you stacking right now? Hit like if this breakdown helped clear up the confusion. Share it with your stacker friends, and subscribe so you never miss the next chapter in this silver series. Like, share, comment, and subscribe. This has been the Global Edition, today's news. Stay informed. See you tomorrow.